Hello, I'm Brent Wilsey. With me is Chase Wilsey. We're from Wilsey Asset Management, and welcome to today's Smart Investing Daily Briefing. Well, today we're talking about intangible assets. We talk about this many times during our post and our newsletter and so forth. We thought today we kind of explain more about what they are, because it's very important for the investor to understand intangible assets. It makes a big difference when you're investing in a company to understand what these are. We always look at the book versus tangible book. And what tangible assets are the ones that you can touch, like tables and cars and so forth. Intangible are ones you can't touch. They're just out there, like a goodwill. You paid too much for a company or the book value. Maybe it is like like Disney has, like Mickey Mouse and so forth. There's a value to them, but you can't touch them. So they're very difficult to understand, but they're very important when it comes to investing.
Yeah, a lot of times they're like patents and copyrights, like Mickey Mouse and such. So, and one thing that's so important to understand is there could be potential credit problems down the road. And you're saying, what do you mean? Well, companies, if they overpay for a company that's known as goodwill, they are going to have to write that down if that company does not work out the way they anticipated, and that hurts their equity. So what does that mean? If they have the same amount of debt but lower equity, their debt to equity is much higher, and they might not meet credit covenants, which could hurt them down the road. And you're saying, what do you mean? Could these write-downs even be that big? Going back to the tech boom and bust, AOL and Time Warner actually had this big merger, and they're like, oh, this is going to be great. This is going to be a great company. Stock price went way up. Well, when everything busted in 2003, they had to take a $54 billion charge against their earnings, and they had to write down that equity. So be very, very careful with those intangibles and really make sure you understand them.
Exactly. I mean, that's so true. I can't point this out enough. So if you're not sure, rewatch the video again and reread it, because it's so important. Company today is a Freeport McMoRan, and you look at this and like, wow, this was great. And I do remember back in 2007, 2008, CNBC and Jim Cramer like, oh yeah, Freeport McMoRan, that's so great. All that. Well, look what happened. Went down here, and then if you sucker down, bought it again. Everything's great again. Look what's happened now. And don't think this is going to happen again, because when you look at the numbers on this company, you'll see that it may come back up somewhat, but look at this. No price to earnings and no price to cash flow. So they have no earnings and they're negative cash flow. And the price to tangible book value, which we just talked about, 4.07, about not quite twice the industry. So not a good position so far.
Yeah, and then taking a look at the balance sheet, I'm even more scared. Taking a look at the current ratio, 1.63, that looks okay. But then I looked at the quick ratio, 0.61. Now that does not include inventory in the current assets. So those are even your more liquid assets. And 0.61 scares me with this debt to equity of 562.8%. Yikes.
Do you hear that knocking on the door? Those are the creditors.
Yeah, and some of the rumors we've heard is they're actually selling assets to kind of pay down that debt. Thing to think about when you're selling those assets is you're decreasing the equity, which could potentially increase that debt to equity if you're not paying down the debt fast enough.
Great point.
Again, raising those credit concerns for the creditors. Finally, though, let's get our target sell price going out to December 2017. Estimated earnings per share, 75 cents. Gives a target sell price of $12.38. So right around that current price. Definitely not be jumping in with this balance sheet.
I'm sitting here shaking over this company.
Yeah.
So, and again, not to say it won't turn around. That's always a possibility, but it's going to be a very, very hard, like pushing a train up a mountain.
I'm not willing to take that risk.
No, I don't either. So, all right. So maybe you're not happy with the current return on your portfolio, on your money. Maybe you're not happy with the current advisor. Well, maybe that means it's time for you to come talk to us. We've been managing money successfully for over 30 years.
Yeah. Phone number here, 858-546-4306, or you can go to our website, smartinvesting2000.com.